Welcome to XM.com. I'm Christina Marujos, and you're watching the Daily Market Comment by Mario Satikiriakos. Wall Street came under pressure at the start of the new week as the rotation away from growth and tech stocks escalated. While the overall stock market is still near record highs, tech investors are quietly heading for the exits, and early-stage companies without profits have been annihilated. There isn't a clear catalyst behind this purge. It seems to be a combination of inflation fears making a comeback and some market participants moving higher along the value spectrum, cutting their exposure to anything with a stretched valuation. That said, the fact that the sell-off has been mostly isolated to the tech and growth spheres is quite encouraging, as it suggests that investors haven't lost faith in the economic outlook. Overall, it is doubtful that this sell-off will last long in an environment where the Fed is still going 100 miles an hour and federal spending keeps flowing as the economic crisis fades into the rearview mirror. In the FX theater, the US dollar was unable to gather much support from the latest bout of risk aversion and continues to bleed early on Tuesday, even as futures point to another negative open on Wall Street. The reserve currency's inability to gain any traction seems linked to inflation dynamics. Market-based measures of inflation expectations have been moving higher with speed lately as traders try to keep pace with the electrifying boom in commodity prices, from lumber to copper to corn. With the Fed doubling down on its promise not to react to an inflation episode and mounting signs that cost-push inflation is indeed imminent, the summer months could be a tough period for the dollar. Even though the greenback's ultimate trajectory still seems positive, the shockingly disappointing jobs report has likely pushed back the Fed's tapering discussion, delaying any dollar strength until later in the year. So the dollar may struggle for a while, but against what? The answer might lie with Britain and Canada. The British and Canadian economies are doing much better, and vaccinations have been impressive in the UK especially, leading the central banks of England and Canada to take baby steps towards ultimately normalizing monetary policy. In this sense, pound dollar and dollar loonie might be better proxies for any short-term dollar weakness than euro dollar and dollar yen. This was today's Daily Market Comment. Thank you for watching at XM.com.